Today we want to talk about the U.S. market. We want to look at it from a financial services perspective, really from banking, what it really looks like, who the players are, and then we want to talk about a concept that is near and dear to the heart for those of us at 11FS, what we call the banking battlefield, and how that is applicable to the U.S. market. So first off, let's talk about the U.S. when it comes to the industry and who the players are. So what's interesting is the U.S. is highly competitive when it comes to options for consumers to bank. As a matter of fact, there's roughly 5,300 banks that have charters within the U.S. And this is of all scale and sizes, from Bank of America, Citi, and Wells, all the way down to small community banks like Citizens Bank of Edmond, my good friend Joe Castilla in Oklahoma. On top of that, you've got another 6,000 credit unions. So if you wonder if American consumers have options when it comes to banking, the answer is quite simple. Yes. So the U.S., from a geographical standpoint, is quite large, as we all know, constituting roughly about 350 million Americans. This is who both these banks and credit unions are fighting for. They're fighting for the deposits of this incredibly large and wealthy market. So when you look at those deposits, this gets quite interesting. Because 81% of the deposits held are held by the top 100 banks. Think about that. 81% are held by the top 100 banks. Now, if you really want to drill down even farther, this gets fascinating. Because of that 81% that we just mentioned, roughly 45% of the deposits are held by 4 banks. This is what's called market dominance. Bank of America, Citi, Chase, and Wells. So that means you have 96 banks that hold roughly 55% of the deposits. And these banks have a lot of capital when it comes to investing in technology and services for their customers. So what does that mean? That means everyone else is fighting roughly at 19% of the market. That also means the challenger banks that have spun up within the U.S. and those coming over from Europe and even Asia, this is what they're facing. Just to make this even more competitive and to understand how we're set up, what's interesting with this 5,300 banks, roughly 5,000 of those are community banks. So these are banks that serve communities. They don't have a national charter. They have usually less than about 10 billion in assets. And over half of those are serving communities that have less than 50,000 people. So we're talking like Texas and the West. So where you don't have big branches from, the key players that are there. So again, we're talking about 5,000 of these institutions. A couple of things that are interesting. One, go back to 1984, there were 17,000 of these community banks. Then you get into the early 2000s, you're down to about 8,000. So think about this. We're seeing the number go down quite significantly over the past couple of decades. And that's mainly due to mergers that are taking place in the market. But I think what's interesting about those 5,000 that we referred to, so 5,000 community banks, if you took all of their assets together and compiled them and combined them, you're talking about $2.3 trillion. That represents all of them. That's roughly the same as Bank of America, one bank. This is the market that we're going after. This is how competitive it is, and these are the players. So what we want to take a look at now is how do they overlay in the banking battlefield, and what are they doing to actually increase the customer engagement they have and the digital products that are being offered. Okay, now that we've talked about who the key players are and how competitive a market this is, what we want to take a look at now is what we call the banking battlefield. And our CEO, David Brayer, did a video about this. If you click on the link here, you can get a detailed overview. I'm going to just hit on the highlights. What we mean by the banking battlefield, and this actually can apply to any industry. So you could put the media battlefield or the automobile industry battlefield. Take your pick. But we're going to focus in on banking, of course, because we are 11FS. What we're talking about is this move from analog services. And what I mean by that, think about most products that you use. And we'll use the newspaper because that's the easiest. At the time, it was paper. It was what the form factor that used for newspapers. The distribution model made sense. The product itself made sense. But as technology came in and we moved more and more into a tech-heavy environment, we moved through a period of time that we called digitized, where we took those services and we applied the technology to that. So for newspapers, we took the content of a newspaper and we put it into a mobile phone. We really didn't change the product that much. It was literally a lift of that into an electronic version. But then when it went truly digital is when we saw industries that were actually impacted, where we actually saw a shift happen, where we saw the business models themselves change. So if you think about the newspapers now, right, content in real time, the subscription services that we see now, you no longer have that one editor that's owning it. The paid models that we're seeing, we've watched the adoption of the newspaper industry apply. This is the same in music when you talk about like Spotify, going from old vinyl records. From banking, this gets very interesting when you look at this. Because in the banking space, we're a highly regulated space that, by the way, is an incredibly heavy user of technology. I always find it funny when people talk about bankers as not using technology, because banking has always been an adopter of technology. But we want to think of this in the battlefield from really two axes. One is the number of customers that we have. How large is the organization? How much actual distribution does it have? How much revenue, therefore, can it make? But then also this path to what is we would call at 11FS truly digital services. And again, David does an excellent job of breaking this concept down. We're going to apply it into banking. So let's think about the U.S. market. Remember, we just talked about this, the 6,000 credit unions, the 5,000 plus banks that we have. So in this, when you look at the model here, we talked about the big four dominance in the U.S. So Bank of America, Wells, Citi, and Chase. So you do have your large banks, those large institutions, which have legacy core systems that are supporting this. They have a significant number of clients, but almost all of them are operating off of dated technology, which could be 20, even 30 years old, whether that be mainframe, but they're definitely, most of them, not sitting on a cloud services system. Then you have those remaining mix of credit unions and community banks that are at all scale and all over this dynamic. So the number of customers they have and the services they provide, we see that at different levels. But again, significant number of customers, which is incredibly important. But all sitting on really dated technology. What has happened, though, is as we've come into this concept of digitizing those analog services, we're seeing the technology stack start to move and work its way across. What we've also seen is the age of fintech, which really took off around 2008 after the financial crash. So you have all these fintech companies and startups, which, by the way, don't have a lot of customers, but do have more modern technology that they've been introduced. The thing is, several of these, though, are starting to mature and have been around. Think about PayPal. PayPal was founded in 1998. And by the way, PayPal's got a lot of customers. They've done extremely well. You got companies like Lending Club, which would be in here. So you have a significant number of these startups. You've got companies like, say, a Lending Club, which have achieved scale over their 15 years. And then we've got some what we would call fintech dinosaurs in the US, but bless them, we do still love them, like PayPal. Great example of each. And here you've got your big top four banks, what we would call our mid-tier, and our community banks and credit unions. Again, what's interesting, though, even for these startups, even for PayPal and Lending Club, is another layer of infrastructure, which is in the US, the service providers. These would be companies like my old employer, TSYS, for example, or First Data or FIS or Fiserv, because a significant number of both these startups and banks at all scale are dependent upon the tech stack and the products that those service providers actually enable them to do. And what's interesting is a few years back, what most of the big banks and these mid-tier companies were afraid of weren't so much these startups, but it was what we call FANG, or big tech. So here we go, the ones we all know: Facebook, Amazon, Google, Apple. In this instance, they're built on cloud services, they're built on AWS, they're built on Microsoft Azure. They are, when we talk about digital services, really as good as they get, because they don't have the legacy overhead that they had that we encountered here, and they have, good God, a significant number of customers. The reality is, on a true scale, I'd probably put them up here off the actual glass. They're massive, and more are coming up, by the way, over here. So this is what we would call the banking battlefield. And what we like to measure and what we talk to our clients about is, how can I go from here and work my way across? What will it take? And what's interesting, it's more than technology, by the way. We stress this a ton. It's the process, and it's heavily on the culture that you have. The actual engagement of your teams and engagement of your management teams to go through this journey, because it's arduous and it's hard. So what we always look at with our clients is, how do I get across the page? How do I go and over time shift my way across? And in all honesty, this can take years in order to migrate, because the reality is, you still got to service your customers. And we know that. How do you get across? Well, what we found is there's multiple ways to do this. Plan A would be to modernize your core, to modernize your services. And we've seen plenty of companies undertake that process to take their ways across. Plan A obviously applies down here too. Hence all the consolidation we saw last year across, when you look at TSYS being acquired, WorldPay, First Data, FIS, the list goes on. Plan B, obviously, would be the startup approach. And what's interesting is watching banks take this approach. So not only startups themselves, but banks investing in these startups, obviously getting venture capital money, but also some banks creating their own startup. Think what Chase did with Finn, or what Wells did with Greenhouse. Now, you could argue some of that was built on this old core stack. True, but a chance to experiment and do this. We're seeing challenger banks in the US like MoneyLion and Borrow Money and Chime. They're all, I would put in this category. What's interesting though is every one of those examples, none of them actually have a banking license or charter. They're essentially a front end, an excellent client experience that's sitting on top of one of these banks' charters. And that's a good move by some of these community banks and smaller banks. And that's when we get in this, which you could say is Plan C, banking as a service. So I am Chime over here. I have a whole new technology stack, but who's holding my deposits? Who's taking care of the actual underlying banking infrastructure? Sutton Bank. Well done. I'm Brex. I'm in the SME market. I'm providing lending and corporate cards to small businesses. Radius Bank, my underlying infrastructure. So I would call that Plan C. Now you really throw a curveball in. What happens when one of these big banks decides that they want to actually create a new stack? So let's take Marcus by Goldman Sachs. Think about what they did. They took a team, they created and developed their own culture. They built out a new technology stack with Marcus. And what's fascinating with this, when it rolled out into the market, no app, by the way, just a website, but an excellent product with excellent rates and excellent marketing, roughly about 80 million. And what happened? Skyrocketed in customers, both in the US and in the UK. I'm going to call that 1D. I feel like a playbook, and I'm Alex Ferguson. I have so many options that I can go for. So outstanding by Marcus. What happens when you get option E, meaning Apple from big tech works with Goldman and introduces a product into market? Yet another option you could do. Or how about Chase. JPMC now partnering with Amazon. You can see where this can go. I think welcome to the new age. You're going to see more and more of situations like that. But 2020 is a fascinating year because we've kind of gone where we never have in the U.S. Meaning we really haven't granted that many banking charters, banking licenses in the U.S. I think if you go back to 2000 to about 2009, we granted something like 1,600 banking charters. That's a significant number. From 2009 to 2018, 43. And roughly 20-something of those were in 2009. We just don't give out charters anymore. It doesn't happen in the U.S., unlike other areas like, say, the U.K. However, in the news recently, and I think is fascinating, is one of these startups, Varo Money. Again, new company, founded roughly around 2015, sitting on a whole new tech stack. They were using Bancor over here as the underlying banking-as-a-service provider. FDIC just came out and said, hey, you qualify. After a 3-year fight, we're going to grant you a charter. They're so close to that. By the time you watch this video, I guarantee you, Varo Money will be a bank. So one of these startups built on a new digital core stack now has that banking charter, and they're on their own. What am I up to? E? Option E. I love it. One way to actually get that charter. Yet another way, what about Lending Club, which has a significant number of clients already, one of the largest online lenders in the U.S. We just found out recently they acquired Radius Bank, one of these small banks over here. Now they have a charter. I'm going to call that E.2. I like that. What do you have? You have a convoluted, very technically complex, multiple players in here and multiple options that you can take a look at. And what you have to find out is what's the best fit for you and your bank? What fits your DNA? How can you go from these antiquated, and I'm going to say that, analog services and actually move into actually truly smart, intelligent, real-time, contextual digital services that you can provide and delight your customers. And remember that small 19% that we talked about? How can you go after them? How can you service them the best way? And I'll tell you one of the best ways, reach out to 11FS and talk to us about it. We love this stuff.